Thank you for joining today's webinar. I am Rob Grunwald, economist in the Community Development Department at the Federal Reserve Bank of Minneapolis. Today's webinar is sponsored by the Federal Reserve System Community Development Child Care Work Group. This work group comprises staff from 8 of the 12 regional Federal Reserve banks and works on research and outreach on issues facing early care and education providers and families with young children, particularly those in low and moderate income families and communities. Also note that today, the views expressed here are those of the presenters and not necessarily those of the Federal Reserve System. Enacted in 1977, the Community Reinvestment Act, or CRA, encourages banks to help meet the credit needs of the communities in their geographic area, including low and moderate income communities. In certain situations, working with entities that provide care and education for young children may help banks meet their CRA obligations. However, we recognize that the banking and early care and education sectors don't always recognize this potential intersection. Today's webinar will elevate the discussion about the intersection between CRA and early care and education and provide context for the Federal Reserve's CRA Advanced Notice of Proposed Rulemaking. The webinar will also feature a discussion with a panel of practitioners in banking, finance, and early care and education. During the webinar, audience participants are encouraged to ask questions using the Q&A feature in Zoom. The panel will address these questions during the last segment of the webinar. Note that a webinar recording and presentation slides will be emailed to you and posted after the event. We also encourage you to complete the survey that we'll send you so you can provide us additional thoughts about the webinar content. Molly Majurley will start the webinar with an overview of the Community Reinvestment Act. Molly is a supervisory examiner in the Consumer Affairs section of Supervision, Regulation, and Credit at the Federal Reserve Bank of Minneapolis. She is part of the management team with responsibilities for CRA, fair lending, and consumer compliance examinations. I will then provide a presentation that connects the dots between CRA and the early care and education sector. With the Minneapolis Fed, I have studied the economic benefits of investing in young children for over 15 years, and am excited to look at how CRA and early care and education interact. Lisa Robinson will then provide a presentation on the Federal Reserve's Advanced Notice of Proposed Rulemaking and share how the Fed is receiving comments about the modernization of CRA. Following her presentation, Lisa will moderate a discussion with our practitioner panel. Lisa is a senior supervisory policy analyst in the Community Reinvestment Act policy section at the Federal Reserve Board, which is responsible for developing and implementing CRA policy. Prior to joining the board in August of last year, Lisa served as a senior examiner with the Federal Reserve Bank of Atlanta, responsible for CRA exams for complex, large, and intermediate institutions. Prior to joining the Fed system, Lisa held positions with a community development financial institution and a regional bank. So I'll now turn the program over to Molly.
We're going to spend a couple minutes talking just about what is CRA so that you have some background on the regulation. So as Rob mentioned, CRA was enacted in 1977 to encourage banks and savings associations to serve the credit needs of their local communities. And CRA does link directly to other Fair Lending and Equal Credit Opportunity Act regulations. So the Equal Credit Opportunity Act of 1974, the Civil Rights Act of 1964, and the Home Mortgage Disclosure Act. CRA was enacted to help curb redlining, which is where loans aren't made in a particular neighborhood based on the neighborhood characteristics. So it's not directly tied to discrimination, but does have some of those same similar characteristics. So CRA is enforced in part through bank examinations by the 3 federal regulators, the OCC, who covers national banks, the FDIC, and the Federal Reserve System. The FDIC and the Federal Reserve cover state member banks. Bank evaluations are public and they include facts and data that support the regulator's conclusion about the bank's performance. We consider a bank's performance context when we're conducting our CRA evaluations. So we include demographic data on incomes, cost of living, and the overall economic climate. We get that information from the banks themselves and also from members of the community. And the banks are evaluated by activities with certain criteria, and it can be a little complex. And so we can link to, when we send out the information, we can link to information about CRA exams in particular. But the exams are based on the asset size of the institution. So for small, intermediate, small, and large banks. Large banks are currently over 1.3 billion in assets, and small banks are below that. And as Rob mentioned, as we talked a little bit too, then the banks are defined by their performance in their assessment areas. The assessment area includes all of the bank's offices and branches and where they have deposit-taking ATMs. And so we want to see where the bank is lending and where they're taking their deposits from, and hopefully those two mesh. And then we're also looking to see how well the bank is lending in any, excuse me, low and moderate income areas within its assessment area. Now, the Census Bureau defines low and moderate income. Low income is anything that's below 50% of the area's median family income or an individual's median family income. And moderate income is between 50 and 80% of that median family income. Geographies are also categorized the same way. So if the median income of a particular census tract is less than 50% of the median income for that area, can either be an MSA or if it's a non-metropolitan area for the statewide area, then that would be considered low income. Oops, I'm sorry, I advanced a little too quickly. All right. All right, so then we go. So there's a lending test, and then there's also for intermediate small banks and large banks, the community development test. And so this is important to understand because the regulation actually defines community development. And it's a little bit more targeted than maybe our general thoughts on community development. So affordable housing is activities that benefit lower moderate income persons. Community services are those services that are targeted to low and moderate income individuals, or could also benefit lower moderate income areas. Economic development is financing small business. I'm sorry, I didn't practice well enough. So economic development, financing small businesses or small farms that provide job training. And then revitalization or stabilization activities. So that would be activities that can help revitalize or stabilize lower moderate income census tracts. That could be housing development. It could be new business development, underserved non-metropolitan middle income census tracts. So to be considered a underserved is, these are qualifications that the USDA puts together, and underserved has to do with whether or not something is considered remote rural. So it's sufficiently distant from a population center, and the community would have difficulty financing fixed costs for essential needs. A distressed non-metropolitan middle income census tract is has unemployment that's over 1.5% of the 1.5% of the national rate, poverty over 20%, or population loss of 5% or more between the recent census years. And those areas were added in 2005 to help in rural areas, because most of the census tracts in rural areas aren't considered lower moderate income. They are considered middle income. And then finally, we have certain designated disaster areas. So after significant hurricanes, flooding, significant blizzards, if FEMA designates a disaster area, then banks can also get credit for activities that help rebuild those areas. And currently, under the regulation, community development activities must benefit the bank's assessment area or a larger regional or statewide area that includes the assessment area. So examples of community development loans are loans that would be made to a small business development corporation, an economic development authority, or a CDFI. Loans also to community development corporations. Also, if banks want to purchase loans from a CDFI or another financial institution, or be involved in a consortium of banks and do a participation. Now, one thing that we want to, some of the complexities are, there are some qualifications on loan size as to whether or not a loan would be considered a small business loan or a community development loan. And then also, we also want to make sure that if a loan is a small business loan, then we wouldn't necessarily be able to count it as a community development loan. Community development investments. So these would be grants or donations that are made to small business development organizations, workforce development programs, community-based childcare targeted to low and moderate income people, youth programs targeted to low and moderate, and healthcare facilities that also primarily serve low and moderate income people. So this would be the grant and donation part of the investments. And then as far as an investment portfolio, that could be an investment in a CDFI, investments in loan pools that target LMI borrowers or small businesses. That could be like mortgage-backed securities sometimes, or some small business SBA loan packages, state or local bonds that would be financing community development projects. As we talked about earlier with the distressed or underserved. So with the underserved, if we're talking about broadband expansion or other infrastructure that would help to attract or retain businesses or residents in those particular geographic areas. Eq2 investments, so that is an equity equivalent investment, and it's a way that a financial institution can either get credit for investing in a particular project that also has a lending component. So they could either get credit for the investment part of the vehicle or get lending credit for the loans that are made as part of that EQ2 investment. Also included in community development investments are low-income housing tax credits and investments in small business investment companies, which is also part of the SBA. And then community development services. So right now under CRA, community investment services have to be tied to the financial, providing some type of financial service. And one of the things that we'll talk about later about how that could change is that you could get credit even if it wasn't particularly tied to financial services. But right now, serving on a board or a committee, participating in an IDA or individual development account program, which are types of savings accounts that have a matching component. And the funds used in those accounts can be used to start a business or down payment assistance or education. Bank officers or board members helping to design a loan program, assisting in marketing or fundraising. I know we've seen several individuals who are active in their local economic development authorities, or helping to administer loan pools or microloan programs, and providing other technical skills such as human resources, IT, or other expertise. So we've gone through that a little quickly, but I wanted to make sure too that we also have time to have our panel discussion. So now I'm going to turn it back over to Rob, and he will talk about the connections between early care and CRA.
Great. So I'm going to talk about the connections between CRA and the early care and education sector. I'll be building on Molly's presentation. But to start with some comments about early childhood development and also the early care and education field. So understanding the value of investments generally in young children first needs grounding in child development. The first few months and years of life are a sensitive period for development, which there is a massive proliferation of connections formed in the brain. The environments in which children grow up influence how the brain reinforces or prunes these early connections. With supportive early experiences, including stable and nurturing relationships with caregivers, language-rich environments, and encouragement to explore through movement and senses, children are more likely to arrive at kindergarten prepared to succeed in school. In contrast, there are experiences that hinder healthy development, such as poverty or exposure to violence, abuse, or neglect. Adverse experiences can lead to a brain wired for negligence or threat, which can impair learning, memory, or the ability to self-regulate. Investments that reach children from disadvantaged situations can lead to benefits to children and society. As you see on this slide, these well-designed long-term studies of high-quality early care and education programs show a high return on investment, including reductions in remedial education, crime, and higher earnings and tax revenue. While children and their families benefit, the majority of benefits accrue to society, to the taxpayers. The study of the Perry preschool, which also shows that benefits transfer to the next generation. For example, the children of parents who attended Perry were more likely to be employed than children of parents who are randomly assigned to the control group. The children in these studies are all from low and moderate income families and communities, a key focus of the CRA. Before describing the early care and education sector, I want to note that early care and education is a subset of a larger set of investments in the development of young children. For example, programs that provide services for maternal and child health, early childhood and mental health, early childhood screening, child welfare, among others, can provide substantial benefits to participants in society. From a CRA perspective, bank involvement in these types of early childhood development programs that serve low and moderate income families may also qualify as eligible activities. While this webinar focuses on early care and education, involvement in other types of early childhood development programs may also fall within the purview of the CRA. The early care and education sector comprises for-profit companies, nonprofit organizations, and government agencies. Providers include childcare centers, home-based family childcare programs, public school-based or private preschool programs, or government-sponsored programs like Head Start and Early Head Start. For today's discussion, we're focusing on providers in the licensed or formal section. Family, friend, and neighbor providers refer to informal, unregulated childcare arrangements. While research has shown that high-quality early care and education can benefit young children, particularly those from low and moderate income families, the sector also provides benefits to parents. A well-functioning childcare sector allows them to enter and remain in the labor force. Recent studies reveal that unavailable or unreliable childcare can cut into family income and increase turnover rates and related costs for businesses. Last year, the Minneapolis Fed sponsored one of these studies in our westernmost state in our district, Montana. The results are shown here. What we also learned is that inadequate childcare has a larger effect on lower income households, which were 3 times more likely to turn down a job offer and 5 times more likely to quit a job than parents in high income households due to childcare related issues. Despite producing substantial societal benefits, the early care and education business model faces a number of challenges, particularly for childcare centers and family-based childcare. Parents with young children are often early in their earning careers and often can't afford to pay higher tuition rates. Childcare is a labor-intensive model, and providers can't reduce staff without compromising safety or quality. Government-funded subsidies for low and moderate income families often fall short of covering the costs of providing early care and education, and providers often lack experience with best practices for operating a business. These conditions may limit opportunities for banks to finance childcare providers and may also limit providers' awareness about the best ways to approach lenders. Making stronger connections between CRA and early care and education isn't the solution to all of these issues. Much more work needs to be done in the public policy realm for society to better reap the benefits of early care and education. But our hope is that CRA can serve as a catalyst to make stronger connections between the financial sector and early care and education now and as the policy landscape evolves. Referring to Molly's introduction to CRA, here are some areas where CRA and early care and education overlap. So regarding lending, many early care and education providers are small businesses. Bank loan amounts under $1 million to early care and education providers in low and moderate income geographies, and to early care and education providers with revenues under $1 million generally receive favorable CRA consideration. Loans over $1 million may also be eligible for CRA consideration in some cases. Investments in early care and education, such as forgivable loans or grants, are also potentially eligible for CRA consideration if they meet the CRA's definition of community development, which includes community services targeted to low and moderate income individuals. Banks could also explore investments in revolving loan funds that focus on early care and education, such as those operated by community development financial institutions. Bank employees can also lend their financial expertise to support early care and education providers or the organizations that support those providers, such as volunteering in efforts to assist childcare operators in boosting their business skills. A key factor for the community development test for early care and education activities is the share of children served that qualify as low and moderate income based on their family's income. The geographic location of community development activities is also important. That is, banks that provide loans, investments, or services to early care and education that provide to early care and initiatives for which the majority of children from low and moderate income families are located, or in low and moderate income distressed or underserved non-metropolitan middle income areas or designated disaster areas, may receive community development credit for these activities. So with that, I'm going to turn the program over to Lisa to talk more about the ANPR.
Thank you, Rob. Let me start presentation. And I also want to thank Molly for that CRA overview, and also thank you for the invitation to be here with you today. Good afternoon, all. I'm delighted to join you today to discuss CRA and ECE, especially following the Federal Reserve's conversation last week on racism and the economy with a focus on education. That was a thought-provoking conversation, and two of the things which resonated with me was 0 to 3, the importance of the first 3 years in shaping a child's brain architecture, and two, if we make this sector a priority across the nation, we can positively impact families, businesses, and local communities and local economies. And as Rob mentioned earlier, as well as Molly, CRA was enacted in 1977, and the last major revisions were in 1995. So many would agree that updates are needed. On September 21st, 2020, the Federal Reserve issued the advance notice of proposed rulemaking, and which I will hereafter call ANPR, which includes proposals on how we evaluate banks, what activities count, where activities count. And the ANPR is a little less than 200 pages long, and it has 99 questions. We won't be able to address everything that's covered in the ANPR, but I would encourage you, if you want to hear more about it, to visit our website, and I will give you that information at the end of the program. I would like to start with a brief discussion of the CRA Modernization Objectives that guided us as we were drafting the ANPR, discuss the why we went down this path, and then walk through a couple of proposals in the ANPR related to qualifying activities, qualifying geographies that I think might be of most interest to this audience, audience of ECE providers, CDFIs, and some banks. CRA modernization, as you see under that first bullet point, includes our first objective was to strengthen the regulations to better meet the CRA's core purpose, as I mentioned, to ensure that the banking needs of low and moderate income communities are being met. Also under this prong is to make sure that we promote financial inclusion, including credit for activities in areas with unmet needs outside of a bank's assessment areas, which may include Indian country. And then the second objective is to update the standards in light of changes in banking over time, including mobile and internet banking. That is to say, what other ways should we be measuring a bank's ability to meet credit and depository needs of its community, knowing that the community can extend far beyond a branch. The third objective of this rulemaking is to provide more certainty, tailor regulations, and minimize burden for our banks. And specifically, this includes providing more certainty regarding what types of activities qualify and where those activities qualify. This also includes tailoring performance evaluations to bank size and business models as local conditions. Because we don't want a one-size-fits-all CRA. And we also want to be more transparent in how performance is evaluated. And lastly, we also want to minimize data collection and reporting burden. So we want to ensure that banks are spending more time in their communities and with their customers than with CRA data collection and reporting. The last objective you see is to provide a foundation for the agencies to converge on a consistent approach for a modernized CRA. Some of the participants on this call may know that the OCC has already reached a final rule, but we want to take time to find out how we can converge and find a way to garner broad support among many stakeholders. CRA reform has been a key priority for the Federal Reserve System, and the board has worked extensively with FDIC and OCC, with whom we share regulatory authority over CRA. And moving on to the two areas that I mentioned that I want to talk about, the qualifying activities and qualifying geographies. In the area of CRA qualifying activities, we've heard feedback from stakeholders that there is a lack of clarity on what activities are eligible for CRA credit. To address this feedback, the ANPR proposes to better define eligibility for qualifying activities such as economic development and revitalization and stabilization in the regulation, among other things. As I mentioned, there are 99 questions. How could the definition of economic development be revised to provide incentives for engaging in activity with smaller businesses and farms, and also minority-owned businesses? That's one of the questions that is posed. The other one, as an example, is for revitalization and stabilization activities. We ask, is there a way to better ensure that activities to help attract and retain existing and new residents and businesses benefit LMI individuals and communities, as well as other underserved communities? The ANPR also seeks feedback on designating certain community development activities as being responsive to community needs or particularly impactful, including affordable housing for very low income households or economic development activity for the smallest businesses and farms. I would add another example, that I'm appreciating much more these days is as an impactful activity is a bank's engagement with an early care provider serving LMI children in a locality where there's a deficiency of providers. That's something that examiners can look at as being very impactful. Related to the bullet point second from the last, the ANPR proposes to automatically qualify activities with Treasury certified CDFIs, and I understand we have many CDFIs on the call, with the goal of increasing capital to these mission-oriented institutions that also serve the needs of LMI communities, LMI individuals, and small businesses. Two questions asked in the ANPR is, should banks receive CRA consideration for loans, investments, or services in conjunction with the CDFI operating anywhere in the country? And how else can CRA be updated to increase support for mission-driven financial institutions? The ANPR proposes to add clarity on where banks can receive credit for community development activities. This is related to, as I mentioned, the qualifying geography question. For example, the ANPR proposes that banks will receive consideration for activities outside their assessment areas, but anywhere within an eligible state, territory, or region where a bank has a facility-based assessment area. So, for example, if you have an ECE provider or a CDFI that has the impactful project or activity that is outside of a bank's assessment area, but within the state or region that the bank operates, the bank might consider partnering outside of its assessment area if they were confident about receiving CRA eligibility. Additionally, the ANPR asks for feedback on treatment of activities within designated areas of need, including Indian country, the Delta, or other areas that exhibit persistent economic distress. And here are just some of the questions related to designated areas of need. You will see, draw your attention to, should the board expand geographic areas for community development activities to include these designated areas of need? And there's the long list of them, colonials, etc. Let me go back one. And then with Indian country, should CRA consideration be given for retail lending activities conducted within Indian country, regardless of whether those activities are located in the bank's assessment area? So those are just some examples of the questions related to designated areas of need. So as I mentioned, in the ANPR, we discuss how we have questions on the assessment area. We have questions on the community development finance metric. We have questions related to community development definitions. A lot of what could not be covered in the time that we have here, because we really wanted to bring to you this fabulous panelist that we have of practitioners. But I will say, before we turn to the panel, here's some information on how you can review the ANPR in depth. And this is how you also can respond with your comments. The deadline is February 16th. And given the importance of the CRA and its impact on communities across the US, it's critical that we get this reform right, and we need to hear from you. So your feedback is encouraged, and we look forward to reviewing your comments. And with that said, I will turn it over. I will not turn it over because I am moderating the panel. We've got three great panelists for you. We have Sally McCready. Sally is the Director of Community Affairs and Corporate Social Responsibility at PNC Bank and Chair and President of the PNC Foundation. She leads programs including PNC Grow Up Great, a $500 million bilingual effort to improve access to high quality early childhood education that serves 5 million children across the 40 US markets. We look forward to hearing more about that program. Then we also have Daniel Niesenbaum, who is the Chief Executive Officer of the Low Income Investment Fund, a community development financial institution that has invested $2.2 billion in community projects. Prior to LIFT, Daniel was a managing director of Goldman Sachs, where he oversaw CRA compliance for the firm's urban investment group and capital investment for the 10,000 small businesses program. Then we have Don Forbes DiStefano, who became the president and chief executive officer of Square One at the beginning of this year. Congratulations, Don. Following a 25-year career with the YWCA of Western Massachusetts, I'm a Southern girl, DiStefano joined the Square One team in 2016 to lead the agency's grant research, grant writing, and program compliance efforts. In 2019, Don was promoted to executive vice president, where she took on oversight of the agency's early education and care programs and family support services, excuse me. And so what we'll do is we'll spend a few minutes with each of the panelists. I will ask questions, and then we will turn it over to the Q&A section. But in the meantime, feel free to start dropping in questions for the panelists at any time. And so, Sally, I'll start with you first, and thank you for being with us today. Over your 15 years ago, PNC decided to focus a large share of its corporate social responsibility work on early childhood through the Grow Up Great program. Please describe what PNC chose to focus, why PNC chose to focus on young children, and highlight some of the Grow Up Great success stories.
Sure. Well, first, Lisa, thanks so much for having me today and giving me the opportunity to talk a little bit about Grow Up Great and the intersection we've long seen at PNC between CRA and early childhood education. So really, our interest in early childhood education grew out of a desire to further focus our philanthropy. And we're going back now to 2003, and we were really looking for a cause that was cutting edge, trending, and could have a tremendous impact on our community. And the more we learned about early childhood education and the tremendous positive impact it has on a child's lifetime trajectory, the more we became convinced that this was the place to focus. And so we launched Grow Up Great in 2004, and even today, years and years later, we still have people stop and scratch their heads and wonder why a bank would be so focused and really have this at the heart of their philanthropic endeavors. But to us, it makes perfect sense. We see investments in high quality early childhood education as both an economic development tool and a workforce development tool, and perfectly connected to our core mission as a bank. It was really, really helpful that when we first started to seriously consider ECE as a focus of our philanthropy, there was a lot of economic research coming out, and we certainly thank the Minneapolis Fed, and actually that's how we got to know Rob Grunwald for some of their early work. Also, as Rob showed, the work by James Heckman, the Perry Preschool study, which showed that there was investments as high as 16 to 1 or 13 to 1 return on investment for every dollar invested in high quality early education. And I can promise you, as bankers, if we could find that investment, we'd make it all day, every day. So that's why we were so excited by the early economic research, which has only grown since the inception of our program and our interest in early childhood education. So all of that to say that in 2004, we launched Grow Up Great as a comprehensive program including grants, advocacy, and volunteerism. All of our employees get up to 40 hours of paid time off every year to volunteer for Grow Up Great. Our program has grown as PNC has grown, and it is now a $500 million bilingual initiative to help prepare children, particularly from children from low and moderate income communities and families, for success in school and life. And you asked about a couple of our successes. Some of the things we're really excited about over the course of the program. We've reached 6.9 million children through our programming. We've provided $190 million in grants through the PNC Foundation to support high quality early education. And our employees have volunteered close to 1 million hours to support early childhood providers.
That's awesome, Sally. There's a conference that we have every year, and because I have COVID on the brain, I can't remember the conference, but it's a conference where all the CD practitioners get together and bankers, and we talk about best practices and successes. And so I will definitely remember to share your name, because I think this is a program that we have to tout to other banks to show them how it's possible to get CRA make the connection between CRA and ECE. And with that said, I want to also say, how has PNC positioned Grow Up Great for inclusion in its CRA portfolio?
So it's a really important component to us, certainly as a bank. And as Molly was talking through kind of the regulatory aspects, we are a large national bank, so we're examined by the OCC for compliance with CRA. We're really, really proud that we've had an outstanding CRA rating since the inception of the Community Reinvestment Act more than 40 years ago. With every one of our exams that we've had since we've had Grow Up Great, we have new field examiners from the OCC, and we've really taken that opportunity to talk with them about Grow Up Great, about early childhood education, and why it should fit under the CRA, especially in the investment test for us, because of the focus on reaching low and moderate income communities and families. And we've been so grateful to the OCC and our field examiners to really listen and be open to this discussion. So we've been successful in having our examiners really look at Grow Up Great as a comprehensive program, including all the investments that we make in awareness, advocacy for increased investment, most importantly, our grants. And so we have been able to get credit for the dollar investments that we've made through the investment test, again, because of the large majority of the investment in grants for low and moderate income people, families, children, communities, it has qualified. And so that's been really important to us, and a great way to not only support our communities, but also receive credit under the Community Reinvestment Act.
Okay. Well, one more question I have for you. Is there any advice that you would provide to your banks, to other banks looking to engage in this sector?
Yeah, sure. There's definitely advice. I guess one of the things I will point out about our exams under CRA is that we have, while certainly our volunteerism is a huge component of the program, and while we do, in instances, we work very closely with Head Start and other early care providers and really ask them from a volunteerism perspective how we can best support them. And in many cases, we are providing financial education, financial support on boards, helping organizations look at their financial model. One of the places we've struggled in getting CRA credit is on some of our broader volunteerism aspects for supporting early childhood education. So we do a lot of like manual labor, painting classrooms, planting gardens, an extra set of the hands in the classroom for teachers. And so because those are not provisions of financial services or education, we have struggled with getting credit for some of those volunteer activities. So I did want to point that out. But generally, I would say for others, banks out there considering whether they can benefit their communities by investments in early childhood education, I just encourage them to think as broadly as they can and think about all of the resources they have at a bank that might support early childhood education. We have been able to make investments in loan funds and ask those loan funds to specifically support, carve out a portion of support for childcare, which is incredibly important given the pandemic and some of the really scary statistics we've seen in terms of high percentages of childcare centers that might have to shutter, 47% increase in costs to operate because of the pandemic. So all aspects of financial support, not just grants, but also on the financial services provisions are really important. And I know some of our panelists are going to talk more about that specifically around the CDFI investments.
Exactly. Thank you, Sally. We may come back to you a little later in the program, but now I'll turn to Daniel. And Daniel, what role has LIFT played in the early care and education sector, and what financing tools has LIFT used? And welcome again, Daniel.
Thank you, Lisa. And I'll echo Sally. I just want to offer thanks to the Fed as a bank regulator to be promoting this industry is super important. Not just using the Fed's convening power, but really also using their research capabilities, as we saw from the earlier presentation, to build the rationale for investing, both public sector and private sector. The case for ECE is beyond compelling, and it makes clear why this sector needs more investment, not just from corporations and not just from philanthropy, though both are important, but ultimately, I think everybody knows the goal here is to make ECE a public good. Just like high school, just like elementary school, it is an essential beginning. And I know I'm preaching to the choir here. So we'll go through this and then have some advice for the ECE providers about how to make these connections to banks or CDFIs. So just by way of brief introduction, the Low Income Investment Fund is a national CDFI. We've been in business for over 35 years and have been engaged in doing early care and early care and education work almost that whole time. We focus on home-based as well as center-based care. And like Sally was suggesting, we see this as a triple impact strategy. We're helping children learn and succeed. We're helping parents to find work and keep work. And we're helping owners to fulfill their passion, develop an income strategy, and actually create employment opportunities for folks in the neighborhood. We started this work actually as an anti-poverty strategy, helping working parents. Then we got more engaged in facilities, upgrading the conditions of those facilities. And then we brought it all together, providing funding for facilities and providing technical assistance to owners. And we then started to advocate for more resources, just on a policy basis at the local, state, and federal level. And we do a lot of work at the national level as well. We're a founding member of the National Children's Facility Network. We recently did background work to help launch successfully the Child Cares Infrastructure Act, legislation that was actually passed, shockingly, in Washington, and will add a significant amount of funding to the block grant monies that flow to state and local governments for ECE centers. So in doing this work, sorry, Lisa, I'm actually turning to the answer to your question now. We've used grants, we use loans when we can, we provide technical assistance, and for those bankers on the call and those in the know, we've actually allocated New Markets tax credits, which is another way to approach your bank to support an ECE center. Mainly, we work under contract with cities, San Francisco or Washington, D.C., where a lot of grant funding will be provided. We receive X numbers of millions of dollars, and then we turn around, we run an RFP, we identify centers, again, home-based, center-based, and pass through grant funding. By the way, since the pandemic started, we've been helping cities deploy CARES Act money, and we've recently just hit the number of 900 grants that we put out on an emergency basis to support ECE centers, most of whom, as Sally noted, are in perilous condition because of the recession. So we've been doing it for a long time. We've done over $177 million of this funding. We've supported over 270,000 slots. And we're now not just focused on the children and the parents, but we're supporting the owners because those owners have not had access to the financing that they need. And for many, and again, this is an industry mostly represented by women of color and who are employing women of color who are earning below minimum wage, and oftentimes the owners and sometimes and often the workers are on public subsidies. So we have a sense that this is the most important thing we could possibly do, yet it's the least paid work that we have relative to many jobs.
Yeah, that was something I read this over the weekend, was the wage level of the workers. I kind of knew about it anecdotally, but to actually see the statistics, and this is just a personal statement, that's troubling. And so thank you for that. What role, the next question is, what role does business technical assistance for providers play in financing early care and education projects? You mentioned that you do a lot of technical assistance, so I was just wondering if you could elaborate on that.
Yeah. And sorry, one note back on the last thing we just talked about. The irony also is that it's very expensive for families. It's among their highest costs, yet the pay is really quite low. So we have to do something about those disparities. So technical assistance is crucial. I think for many people, we all know that getting access to capital is a critical impediment. It's a giant issue, and it's often not just the capital, right? It's the technical assistance and the business support. And I'm teeing that up because, as you've heard from Sally, banks can provide both of those as well as CDFIs, so both are imperative. So we provide technical assistance related to both facility projects, like helping people get through the process of upgrading their facility, as well as business operations, and those are crucial. Many times, in many cases, we're working with entrepreneurs who are in this business because they're committed to the mission and they love educating children, but they've taken on running a small business. And these are not always people who come, with small business expertise, and it's hard. And the model is so challenging because we know that the pay and we know that the government reimbursements do not cover the costs. Mm-hmm. So as Dawn will share with us, the person who's really doing the work here, you're juggling and you're running and you're trying to collect reimbursements that don't cover costs, and you're trying to raise money while you're running a business, while you're taking care of children. It's sort of crazy. So we don't make technical assistance a condition of a loan. We provide it along with the financing. And we start, as many CDFIs do, by helping these owners qualify for the financing, get through the financing application process. And then we help, as I said, with just managing the project. We don't, by the way, provide technical assistance specifically on the pedagogy, on the education curriculum. We leave that to the experts, though we do focus on quality, and we look at what we think a quality curriculum is, as well as standards of care.
All right, but it's a great way for banks to partner with CDFIs. I mean, if they don't have, if this doesn't meet their risk appetite in terms of this sector, and if they have ECE providers that come to them and they don't want to completely deny them credit or anything like that, this is the perfect way in which they can partner with CDFIs and refer these ECE providers to CDFIs that have the expertise in this area. So one last question for you, Daniel, before I turn it over to Dawn, and that would be, would you like to describe a early care and education project that increased access, a particular example of one that increased access to LMI families that included bank financing?
Yeah, but let's talk generally just first, because I think you just hit the money shot right there, which is for those listening on the call, how do they really understand whether CRA is going to solve all their problems or not, right? So let's just very briefly remind people, as you heard from Molly and as you heard from Rob, CRA covers a wide range of activities. Primarily, it's access to branches and home mortgages and small business loans and a lot of other things. As you heard, early care and education can be a qualifying and is a qualifying activity. But to be clear, there's a lot of things on that list. There's nothing in the CRA yet which prioritizes early care and education at the top of the list. But so that's just important to know. Banks do a lot of this, as do CDFIs. But the bottom line is that grant funding is one thing and getting a loan is another. And ECE centers are hard to finance for the reasons that we've talked about. Banks are not required under CRA to make a loan that isn't supporting, that doesn't pencil out, that isn't safe and sound. So we all know that the amount of, you can make a loan to somebody who can pay debt service, but if you're kind of not collecting enough revenue to pay expenses, you don't have a lot of extra room to pay for a loan. Or if you have that same dynamic, you don't have the chance to build up a big balance sheet. And when banks look to make loans, they are looking at things like debt service coverage and cash flow and the strength of a guarantee. Banks will often try to use SBA programs, but actually those SBA requirements are stringent and are not often comfortable for ECE providers. So again, we're at this moment where we really need to be doing this. I think right now there is this possibility to raise up this issue in CRA, but more broadly, we're at a moment in time because of COVID, because of the pandemic, where everyone's attention is on this. We have essential workers who are supporting essential workers in this sector. And so I think it's, the need and opportunity is significant for banks, for foundations, for others. So here's what I would advise, basically. And then I'm happy to talk about a project, but I really just want to make this as useful for your attendees. I would call your bank. There's a lot of folks like Sally or others at banks who are responsible for this work. I would call the bank and ask what resources are available. I would ask the bank for a grant, and when they say no, I would ask again, and when they say no, I would ask again. Banks do a lot of grant making for CRA. I would ask to talk to the CRA officer at a bank who's kind of the gatekeeper for all of the loans or grants or technical assistance. And I would invite that person to come to your center and take a tour. Banking is a relationship-driven business. What you're going to show that bank officer will be very compelling, and I think that's just a good way to go. I would ask the bank if they could have somebody from their bank sit on your board or provide technical assistance. As Sally said, not just the painting and other types of things, but the financial assistance, helping somebody go over your budget. I would Google and look for local CDFIs in your communities. We do this work. We're there as an intermediary between banks and your businesses. And by the way, think broadly. I would talk to local electeds and say, as you're approving development projects, affordable housing or other, we want early ECE facilities to be provided as part of that community service, not just a bank branch, with all due respect, or a pharmacy or a grocery store, but we need childcare. So those are the types of things I would commend to you and recommend. We've done hundreds of projects. We've helped all kinds of people. It has started with those kinds of relationships or a referral from a bank. And so I think that's a great strategy for going forward.
Okay, very good. And so I may come back to you for another example, but I want to turn it over to Don first. But before I do that, you mentioned a good point about we need to raise up the issue of ECE with CRA examiners and with the regulators. And in our ANPR, there are two things that we're proposing. There's a pre-approval process where if banks are working on a project and they want to know in advance whether something qualifies, then that's one avenue. And then we're talking about issuing an illustrative list of qualifying activities. And I know since my involvement with, Rob and Molly in this project, I would definitely see, I definitely know that we need to raise up activities related to ECE, both grants, loans, and services. So thank you for mentioning that, because that was not in my earlier remarks about the illustrative list. So on to you, Don. I have several questions for you as the practitioner, as the president of your organization, but you've heard a lot so far, and I just wanted to first open it up for you for any opening comments before I I pose any direct questions to you.
Sure. Well, I just want to thank you, Lisa and Molly and Rob and the rest of the team. It's not often we get to be involved in a conversation like this, and so it's exciting. I just want to frame the fact that Square One is a large social service agency. One of our primary focal points is early education and care. We're located in Springfield, Massachusetts, which is the third largest city in the Commonwealth of Massachusetts, although we are not that large. So Springfield and Boston are nowhere comparable. Square One has 500 children in our care. 100% of those children fall into a low income category, and 100% of them have some sort of adverse childhood experience or trauma related. So just to frame what I say in that way.
Thank you. And so what would you say are the top 2 or 3 challenges, financial challenges, in providing high quality childcare education?
Sure. So unfortunately, there's more than 2 or 3, but I'll give you the top 2 or 3. The biggest challenge is the way that the rate reimbursement is structured in Massachusetts. So in Massachusetts, it's a per child, per day reimbursement. So I only get paid if I have a child enrolled in a slot to receive care. The actual rate itself is also below what the actual cost is. So I clearly don't let staff go when enrollment dips below a certain level. I have lights, I have rent, I have all of those static expenses. The other challenge we have at Square One, and I'm guessing it's true for other providers, because 100% of our children are low to middle income families, we don't attract or draw the private paying families. So for some systems, that's how they balance their books. They're able to have a certain percentage of private paying families who pay a higher rate to help balance out the lower rate. At Square One, we're 100% subsidized. So we don't have that opportunity or interest. So those are my top 2, Lisa.
Okay, thank you. And you may have mentioned this, but are you in an area that's gentrifying? Or yeah,
not so much. What we have here in Springfield is it's a very old city. It's a city of homes. We have a lot of families who are multi-generational. So whether you're working at Square One, chances are you might be a Square One baby, and you might have joined us as a high schooler and stayed with us as an early educator. Most likely you're living with 1, 2, or 3 generations in your home. So it's an old city of homes.
Okay, that's good to know. So how does public policy such as government child care reimbursements, and you touched a little bit about this, that you're 100% subsidized, but how does that affect your financial stability of your early care and education programs?
Sure. So for Square One, we are about an $8 or $9 million agency. So we have a substantial annual budget. However, because the rates don't meet the level of expenses, our fundraising goal on average is about $800,000 a year. Now, to put that in perspective, in the city of Springfield, most fundraising organizations raise about $150,000 to $200,000 a year. So to have a goal that is substantially larger than the average fundraising budget creates quite a conundrum here at Square One. We also in Springfield, in this Pioneer Valley area, we don't have large corporate headquarters. We don't have a strong fundraising base to go to. So that creates quite a problem for us.
I know when we met earlier, a couple of weeks ago or last week, they're running together, you talked about a relationship that you have a bank. And I was just wondering if you could talk to the participants about that relationship and how it came to be.
Sure. We have a wonderful local bank that we have a great relationship with. And everything Sally and Dan talked about in terms of best practice is true. They volunteer with us. They assist us in terms of budgeting or serving on our finance committee. But I will say in particular, what that bank has offered to Square One is a lifeline. We lost a significant building in a tornado in 2011. 18 months after the tornado, we lost the other center that was very much profit driven, believe it or not. We lost that building in a gas explosion. So we've had this string of bad luck. And what our local bank was able to do for us is to offer an emergency line of credit. So we had that relationship established. To Dan's point, we didn't have the strongest balance sheet. We didn't have a lot of liquidity or capital on hand just to survive those disasters, but then to rebuild and get back to business, because we are a cornerstone here in Springfield and people needed a place for their children to go. So that was critical for us. They also have encouraged their employees to consider us when they're doing their annual donations. So not only is the bank investing in Square One, but their employees are investing in Square One as well, whether they're donating or volunteering.
Thank you.
Mhm.
I have one more question before I just open it up to all the panelists to ask each other questions if you like. But what advice would you have for bankers looking to engage in early care and education sector from your experience with your own bank?
Sure. I don't know that I think a lot of those pieces of advice were covered. Sally and Dan mentioned serving on a board, serving on a finance committee. You know, I pride myself on my ability to run a business, but I am a nonprofit management trained person. I'm not a finance specialist. I am not, you know, a business executive with an MBA. I care about children and I care about educating children and supporting their families. So it's helpful for me to be able to pick up the phone and call my banker, a banker that knows me for who I am, understands my challenges, and then calls me when there's an opportunity. You know, when the pandemic hit, I received a personal phone call from my banker. Are you okay, Dawn? Are your folks okay? What can we do? When PPP was being launched, I got a phone call. I got a personal email from my banker. How can we help you to apply for these funds? It's that type of attention to detail and knowing my business that is critical. It's been critical for our survival.
Yeah, and I hope that is one of the takeaways from COVID-19 and the PPP process, is making sure that ECE providers do have relationships with their bank. So that's just a side note. You know, before we turn it, do we have any questions from the panel? I'm asking Paul or Rob. If not, I will ask one more question of Sally. Or is there anything, Sally, you want to elaborate on it from what you've heard?
No, gosh, I learned a lot too. And so I really appreciated the discussion. So I don't have anything to add, but happy to answer questions.
Okay, well, let's see what we have in the chat. Rob, I see something in here about English not the first language. What way can lenders make this information available? I just need them, the individual, to respond, make what available?
Oh, you know what, we maybe to make it just broadly, and we just have time for one more for this final question.
Oh, okay.
And then we'll have to adjourn. But in terms of any advice about serving smaller home-based providers, we often get questions about serving providers that may speak a language other than English or may serve rural communities. And so if each panelist want to take half a minute each, that'd be great.
I'm happy to jump on there, Rob. I can't remember if we had a rule about going around, but my quick advice would be that most often family child care providers are associated with some sort of system of care. So Square One supports 35 local family child care providers. So in and of themselves, they're small businesses, but we act as their technical advisor. We do their payroll. We do all of their professional development. So I think there's some best practice there that we could connect with those systems of care to the banks.
And I would just add, do internet searches. I know at PNC we provide our services in many languages through our 1-800 numbers. So, really, if there's something specific that you need, so many banks offer services in a multitude of languages. So just check out in your area what you're looking for. And then totally agree with what Dawn said. We work with many organizations that serve a broad array of childcare providers. Your local NACI chapter, really good at being in the know about financial services in your area and support that can be broadly offered to those family, friend, and neighbor care.
Yeah, nothing to add other than that CDFIs, provide some of this work on a dual language basis as well.
Great. Well, thank you for those responses. Thank you, Lisa and Olive and Sally and Dawn and Dan for wonderful panel discussion. I know we could continue to go longer, but our time is wrapping up now. We do have a couple of questions that are left unanswered in the chat, and I'll see in the Q&A. We have a question from Laura and Jerry Cutts at First Children's Finance. We'll put together some responses for those for our follow-up email that we'll send you after the event. And also we'd appreciate you to fill out the survey, provide any additional thoughts you have about CRA and ECE and also the ANPR. And so with that, thank you for joining today. And we look forward to continuing this conversation on the Community Reinvestment Act and early care and education.